Hey guys, I'm Chad.
And I'm Chuck.
And we're from Langford Insurance. Sorry we couldn't be there in person today. Unfortunately, we had a family emergency. We did want to share the same information with you that we would have if we'd been there. And that's the home insurance plays a big role in your home buying process. So first, we're going to talk about how the insurance affects your loan and what you need to do to stay qualified. We're going to talk a little bit about the market value or the purchase price, what you buy the home for, versus the insurance value or what you insure the home for, and why those might be a little bit different. Then we're going to look at some ways that you can lower your premiums so that you save money on your insurance and you also stay qualified for your loan. And then we're going to leave you with some key takeaways that will help you in your home buying process. So first, Dad, why don't you tell us a little bit about how the insurance affects your loan?
Chad, it actually affects it in a big way. Most people don't know, especially first-time home buyers, how much of your home insurance is actually a part of your mortgage. It can be as much as 10 or 20% of your mortgage payment. So what's the goal here? The goal is to try, while we're still protecting you properly, is to keep that cost as low as possible to stay in check with your debt-to-income ratios that Chad talked about a little earlier. Also, one of the things that's important is to make sure you get a 4-point inspection, especially on older homes. Now, please understand, a 4-point inspection is different than the home inspection that your mortgage lender may ask you to get, that they need for their requirement. But you need that 4-point inspection so that you know that your plumbing, that your roof, your air conditioning, electrical are all in good working order, okay? Because what you don't want to do is buy the home and find out these things are bad, then you get your inspection by your insurance company and find out they want to cancel your insurance because things need to be that were not corrected.
Right.
So if you find deficiencies in this 4-point inspection, you want to try and negotiate those with the seller. Oftentimes you can either get credit off the purchase price, or the seller will actually have those deficiencies repaired. So make sure you get that done either before you sign the contract or definitely before closing, and very important.
Yep. All right, so debt to income ratios, it's a huge deal. If you don't qualify for your loan because of debt to income, you can't buy the house. So we want to make sure we can help you out there. Let's look at a scenario of what this looks like. So right here we've got a household that's got an average income of $5,000 a month. If we add up all of their debts, their car loans, their student loans, their credit cards, their anticipated mortgage payment, and their insurance, this is not comprehensive, but just an example, we come up with a total debt to income ratio of 44%. Now, most mortgage companies require a maximum of 43% debt to income ratio, which means your total debt can't be more than 43% of your total income. In this case, that insurance of $150 a month disqualified them for their loan. What we can do is try to work with you to get that insurance payment lowered. So in this case, we went from $150 to $100 a month. All of the other debts are the same and their income's the same, but now they're down to 43%. They qualify for their loan and they pay less for their insurance.
That's important, Chad. One of the things that we want to look at too is also market value versus insurable value. Market value pretty much is what the market will bear, what your appraisal is, or what you paid for the home.
Right.
But that includes land. Just remember, land is not insurable, okay? So you got to back that out of the equation. But what is insurable is the replacement cost of the structure itself. And you want an accurate replacement cost. And there's some things to look at when we're doing that. One is we want to know the type of finishes. We want to know if you have any detached structures, for example, a garage. Do you have a pool? Is it in-ground, above ground, detached, screen enclosure, so forth? What type of shingles do you have? Those all affect the insurable value. One of the things that Chad and I are real good at is we have a real strong construction background. We actually have a combined 55 years experience. Chad has a building degree.
A building construction degree from the University of Florida. Go Gators.
Go Gators. All right, and I'm a certified general contractor and I'm still current. So what does that mean to you? That means that we can do real accurate replacement cost estimates. So make sure that your cost is not too high or not too low, but it's just right. So make sure you buy the right policy. Thanks for that help, Chad.
Not a problem. All right, so an example of what that looks like. Let's say you buy a house for $185,000. You're excited about it, it's great, but then you go get insurance quotes and the insurance company's gonna say, hey, we need to insure that house for $207,000. You might be thinking, why am I gonna insure a home for more than I paid for it? Well, a couple of reasons. One, you might have gotten a really good deal on the house and it's gonna cost more to build that house than it was for you to buy it because you got such a good deal. Two, market values fluctuate so often, we want to make sure that we're covering the home for the full reconstruction cost or the replacement cost. So if the home gets consumed by a fire or a total loss, like a hurricane or a fire, we want to make sure that we have enough money to go in and clean the area up, take away all the debris, and then go back in and rebuild that same house back to the way it was. So that's why we insure it for the replacement cost and not the market value.
So what are some of the things we can do to lower your premium? One is we want to look at the age of the home. So if we compare two homes, one built in 1982, one built in 2012, let's say they're similar square footage and maybe even similar in cost. You pay the same for both of those. The older home will carry a much higher insurance premium, basically about $2,200 a year. We know that from experience. The newer home, the insurance could be about $900 a year. That's a $1,300 a year difference, or a delta. So why is that important? You can put that $100 a month in your pocket instead of giving it to the insurance company, okay? Or you can use it to lower your debt to income ratio so that you qualify for your loan. Or what if you take that $100 and buy more home or a better home than what you thought you could afford because you looked at something that was newer instead of something that was older. Remember, older costs more to insure, newer costs less to insure.
Right.
Important when you're home shopping.
Exactly. Something else that's important when you're shopping for a house that not a lot of people think about is the shape of the roof. How's the roof, what does the roof look like, the geometry? Over here we've got what's called a hip roof. This is probably the best type of roof when it comes to insurance because they're going to look at that and say, okay, the wind's going to deflect off of those slanted sides. It's not going to cause as much damage, so it's not as expensive to insure. Second type of roof that people often look for is a gable roof. It's a great roof, but it costs more to insure because the wind can get up underneath those sides and lift that roof off, causing a lot of damage. So the insurance company is going to charge you more to insure that home. Third type of roof that's the most common is a flat roof. Oftentimes you'll see this on a home that maybe had a screened enclosure that was converted to a forward room. It's now air conditioned. They put a flat roof on it that's connected to the house. That's a lot of times going to disqualify you for insurance. A lot of insurance companies won't even write that. And the ones that do are going to charge you a ton for it. So you want to stay away from flat roofs. If you're shopping for a home, you want to talk to your realtor, maybe narrow your search down to hip roofs. You're going to save a ton on your insurance. Speaking of roofs, Dad, why don't you tell us a little bit about the wind mitigation inspection?
Wind mitigation has to do with how your roof is actually attached to the home itself. So there's about three things that really make up how the roof structure. One are the trusses. That's just the structure that supports the plywood on top and also supports the shingles. So how are those trusses attached to the home? How is the plywood sheeting attached to the trusses? And how are the shingles attached to the home? So we know that the Florida Building Code changed in 2001. So most of the homes built 2002 or newer, they already are built to the new hurricane code and they qualify for most of the mitigation credits.
Right.
So there's not really much need to get a wind mitigation inspection if the home was built after 2002. However, on older homes, if a roof was put on after 2002, it's put onto the new hurricane codes and you should qualify for some of those credits. You may not get them all, but you may get some. So what we recommend you do is when you get a wind mitigation report or an inspection, that's going to cost you roughly $100, but it could save you $500, $1,000, $2,000. We recently had one homeowner that saved them almost $3,000 a year, and that's just on the front end, that's every year.
Right.
So wind mitigation, very important, and remember homes after 2002 with a new roof, you want to make sure that you look at getting that inspection done.
Right.
Pay the money and get it done.
Absolutely. A third area that we can look at to lower your premiums is your personal property or your contents coverage. That's things like your furniture, your TVs, your electronics and appliances, your clothing, all the stuff that's not a part of the house that you can take in and out. Typically, the default coverage for that amount is 50% of what we insure your home for. So if we're insuring your home for $200,000, you're going to usually get about $100,000 in contents coverage. You want to make sure that this is accurate because let's say you add it all up and you've only got $50,000 or $60,000 worth of contents. There's no need to pay for the additional personal property coverage because you're never going to see that money even if everything's destroyed. They're only going to replace what you had. So we want to make sure that number is accurate because you can save a lot of money there just by reducing that coverage to the right value. On the flip side, if you need more than 50%, you want to make sure you tell us, that way you're adequately covered. A second part of that is how the insurance company evaluates that loss. So they can look at your personal property as from a replacement cost standpoint or an actual cash value standpoint. Replacement cost says I have a $2,000 TV that I bought 10 years ago. It gets damaged in a fire. My insurance company is going to replace that TV with a brand new $2,000 TV. Actual cash value says same thing happens, fire, TV's gone. That $2,000 TV might only be worth $300 today. I'm only going to get $300 for it. I can't go replace that TV. It is a big savings. It can save you several $100s a year on your insurance. So if you're looking to squeeze out a little bit of savings on your insurance to stay qualified for your loan, this is a big area that we can play with.
So one of the things that we can also do to lower our premium is look at deductibles. We primarily have two deductibles. One is for a hurricane. We all know what hurricanes are. Okay, and the other one are all other perils. What does all other perils mean? It's everything but a hurricane. It'd be a fire or anything else other than a hurricane. And how the deductible works during a hurricane is 2% of coverage A that you pay first. So let's say to rebuild your home is $200,000. You pay 2% of that, which would be $4,000. So a lot of people get confused and think it's 2% of the repair. It's not. It's 2% of the structure A. So 2% of structure A, $200,000 is $4,000. Let's say you have $6,000 in damage. You're going to pay $4,000. The insurance company is going to pay $2,000. Well, it doesn't work that way with all other perils. All other perils is strictly a $1,000 deductible. Now the deductible can go up from there, but the base is $1,000 deductible, the standard default. So if you have a fire, not a hurricane, but a fire, you're going to pay $1,000 and the insurance company is going to pay everything else. Note that if you're looking to save money on your premium and keep that debt to income ratio in check, you can raise these deductibles and that will help you on the premium. Just be careful and not get that hurricane deductible so high that if we do have a bad storm that you're not paying $10,000 or $20,000 before the hurricane kicks in or the insurance kicks in.
Right. All right, guys, I know we've covered a lot today. We've tried to make it quick. Here's some key takeaways that can help you in the home buying process. First, once you've kind of zoned in on a home that you're looking to buy and getting serious about it, go out for insurance quotes. Make sure you're doing this at the beginning of the process and not waiting until right before closing to get insurance, because we don't want the cost of the insurance to kill your DTI, your debt to income. So make sure you're taking a look at that first. When you're shopping, just keep in mind that homes built after 2002 usually get most of the wind mitigation credits and they're much less expensive to insure. So you might be able to buy a newer home rather than a home built in the 70s or 80s. Third, choose a home with a hip roof if you can. Have your realtor show you houses with hip roofs. If you're shopping for both, we can give you quotes on both, and you can see the difference. It's several $100s a year. Speaking of roofs, get a wind mitigation inspection. If you're buying an older home or a home built prior to 2002 and it's got a new roof put on it, pay the $100, get the wind mitt, and save that $600, $700, $800 a year usually on your insurance. If we've done all of that and you still don't qualify for your loan, maybe you're just over that 43% or whatever your lender requires, we can play with your coverages and your deductibles to kind of squeeze out a little bit more savings to make you qualify for your loan, and we can always change those things later. But we want to make sure that you're properly protected, but we also want to make sure that you get the loan. I think that's it for today, guys. Again, I'm Chad. This is my dad, Chuck. And sorry we couldn't be there today, but if you guys have any questions about the insurance process or the home buying process and how the insurance plays a role in that, feel free to shoot us an email. Here's our contact information. Andrew's going to give you some business cards. Feel free to reach out to us. We're here to help answer any questions that you might have.
Thanks for coming.
Enjoy the rest of the workshop.